All right, let's dive into one of the most misunderstood, yet absolutely crucial tools in trading, the stop loss. And I don't mean the basic set it and forget it kind. No, we're going to move you from that amateur approach to a truly professional, dynamic system, one that actually adapts to the market and, really protects your hard-earned capital.
I love this quote because it just hits the nail on the head, right? A seatbelt. Yeah, it's essential, but it's totally passive. It doesn't make you a better driver, and a basic stop loss? It's exactly the same. What we're aiming for here is something totally different. We want an active, intelligent system, the kind that helps you navigate those really rough market conditions like a pro, not just sit there and brace for the crash.
So, you might be asking, why all this focus on cutting losses? Isn't it just about being disciplined? Well, yes and no. It goes way deeper than that. To really get why this is so critical, we've got to look at the math. And I'll warn you, it's simple, but it's absolutely brutal.
Okay, just look at this table. The asymmetry here is, well, it's shocking. A 10% loss, okay, you need an 11% gain to get back to even. Manageable. But look what happens when you let a loss get bigger. If you take a 50% hit, you now need a 100% gain just to get back to where you started. That's not just a setback. That's what's called wealth devastation, and for good reason. This right here, this math, is what blows up accounts. It's why making sure big losses never happen is, well, it's job number one.
Okay, so here's our roadmap. We've just covered that dangerous math. Next up, we're diving into the pro's go-to volatility tool. After that, we'll talk about what to do when your big idea just stalls. Then we'll see why context is everything. And finally, we'll wrap it all up by building your own pro-level system.
So, how do the pros sidestep that devastating math we just saw? Well, here's the secret. They don't just pull a number out of thin air, like, oh, I'll just use an 8% stop. No way. They use a tool that's smart, one that adapts to each stock's unique personality. And that tool is called the average true range, or ATR for short. The easiest way to think about the ATR is that it measures a stock's normal, its daily wiggle. So instead of using some random percentage, you're setting your stop based on the stock's actual recent behavior. It's brilliant, really. It gives the trade enough room to breathe, to do its thing, but it boots you out the second the move against you becomes abnormally large. And that's usually a huge red flag that something's really wrong. And here's the best part. The ATR isn't some rigid rule. It's not one size fits all. You can actually dial it in to fit your style. Let's say you're in a fast-moving, short-term trade you feel really good about. You might use a tight stop, maybe 1.5 times the ATR. But what if you're holding a really volatile stock, or you're in for the long haul? You'd use a looser stop, say 3 times the ATR. That way you don't get shaken out by the stock's normal, everyday noise.
So what happens when you do a calculation like this? You get a smart, data-driven stop. That 8% risk isn't just a random number anymore. It's scientifically calculated based on that specific stock's actual volatility. And that changes everything. Because now, if the price breaks that level, you know it's not just random market noise. It's a statistically significant event. It's the market telling you, hey, your idea was probably wrong.
Okay, so we've talked about price risk, but that's not the only danger out there. Sometimes the biggest enemy is time. You know the feeling, right? A trade isn't really losing money, but it's not going anywhere either. It's just sitting there, dead money, tying up capital you could be using somewhere else. Well, the pros have a tool for that too. It's called a time-based stop.
Yeah, pros use these to get out of that dead money trap. Because here's the thing, every single trade idea has a time limit, whether you admit it or not. If you bought a stock expecting a quick breakout and a week later it's gone sideways, well, your thesis is failing. Or if you're holding a growth stock and its momentum just dies for 2 quarters straight, the story has changed. A time stop is what forces you to look at the clock and say, okay, time's up. Now, I gotta be honest, there's a trade-off here. Time stops are amazing for freeing up your cash and keeping you nimble. But, and this is a big but, they can be subjective. And yeah, sometimes they'll kick you out right before the stock finally makes its big move. It's frustrating. That's why using them correctly takes a ton of discipline. So here's the golden rule, the most important thing to remember. A time stop is not your sell button. Think of it as an alarm clock.
It's the alert that goes off and says, hey, pay attention. This trade isn't working out the way you planned. That's your cue to then look for a real concrete reason to sell, like a break with a key technical level. The time stop is your co-pilot, not the one flying the plane.
And that whole idea of confirmation, that leads us perfectly into the next layer of pro-level thinking. This is so important. The absolute smartest traders live by this rule. Your stop-loss strategy must match your reason for buying the stock. Simple as that. Your why for getting in determines your when for getting out. And the difference is actually really clear when you think about it. If you bought a stock because you saw a cool chart pattern, like a breakout, then your reason for selling should also be based on the chart, right? But if you bought a company because you love its business and you plan to hold it for years, then a 10% dip doesn't mean anything. It's just market noise. Your real stop loss in that case is a fundamental one, something that tells you the business itself is in trouble. Okay, let's make this super practical. Picture this. You own a stock you think is a quality company. You bought it at 500 rupees and now it's trading at 480. You look at the chart and there's a clear, obvious support level right at 470. So, what's the move? Where's the right place to put your stop? And here's the pro-level answer. You ready? There is no single right answer. The correct move depends 100% on why you bought it in the first place. If it was a quick trade, you absolutely have to respect that technical stop at 470. But if it's a long-term investment and the business is still solid, you might just hold on. It all comes back to that golden rule. Your exit logic has to match your entry logic. Okay, let's recap. We've got our ATR stops for volatility, we've got time stops for when things stall, and we know that our stops have to match our context. Now it's time to put all the pieces together. Let's build the full system, because being a pro isn't just about cutting your losses. It's also about managing your winners. Think about it. Once a trade starts moving in your favor, your original stop loss is way down there. It's almost irrelevant. So you don't just leave it there. You manage it dynamically. You could use a trailing ATR stop, which automatically follows the price up, locking in your profits as you go. Or another great technique is to scale out. Sell a little piece of your position at different profit targets. Both of these let you bank some gains while still leaving some skin in the game. But before we get to the final checklist, we have to talk about the flip side. These are the big mistakes, the cardinal sins of risk management. And number one, this is the account killer. Moving your stop loss down, further away from the price, just because you're hoping it will turn around. Please, never, ever do this. That's how you take a small paper-cut loss and turn it into a devastating one. Your stop is a line in the sand. It is not a suggestion. So this right here, this is your blueprint. This is your checklist for building a professional system. And notice the most important part. The work starts before you even click the buy button. You're planning your exit, calculating your position size. Then, while the trade is on, you're actively managing it. And the glue that holds it all together? Pure, ironclad discipline. You make a plan, and you execute that plan. No hesitation, no emotional overrides, period. And that brings us full circle, right back to where we started. So I want you to really think about this now. After everything we've covered, take an honest look at your own trading. Is your stop-loss plan just a simple passive seatbelt? Or are you ready now to build a truly professional, dynamic system? The kind of system that doesn't just prevent disaster, but actually helps you protect and grow your capital for years to come.